Imagine owning a small piece of companies like Apple, Tesla, or Google. That's exactly what investing in stocks allows you to do. But before you start investing, it's important to understand some basic stock market terms. In this video, we'll explain them in simple English. Let's begin. A stock represents ownership in a company. Each unit of a stock is called a share, and anyone who owns shares is known as a shareholder. Stocks are bought and sold on a stock exchange, which is a marketplace for public companies. A company becomes public through an initial public offering, or IPO, where it sells shares to investors for the first time to raise money. When stock prices rise for a long period, it's called a bull market. When they fall over time, it's called a bear market. Volatility measures how much a stock's price moves. Higher volatility usually means higher risk. Trading volume shows how many shares are traded, while liquidity tells us how easily a stock can be bought or sold. Capital is the money used to invest or grow a business. Sometimes, excitement pushes prices far above a company's real value, creating a market bubble. Some companies pay part of their profits to shareholders. These payments are called dividends. Companies with long histories of stable performance are often called blue-chip stocks. Your portfolio is the collection of all your investments, while each investment inside it is called a holding. Unlike stocks, bonds are loans you give to a company or government in exchange for interest. Both stocks and bonds are examples of securities. Most investors buy and sell investments through a broker. A common strategy is going long, which means buying a stock with the expectation that its price will increase over time. Finally, an asset is anything that has value, such as stocks, bonds, cash, real estate, or gold. Now that you understand the basics, let's move on to more important investing concepts. Now that you understand the basics, let's explore some important investing terms every beginner should know. Commodities are raw materials like gold, silver, oil, wheat, and coffee that are traded around the world. Yield measures the income an investment generates compared to the amount invested. One popular valuation tool is the price-to-earnings P/E ratio, which compares a company's share price with its earnings per share. Investors use it to help judge whether a stock appears expensive or relatively affordable. A stock market index tracks the performance of a group of companies and provides a snapshot of the overall market. Futures are contracts that require buying or selling an asset at a specific price on a future date. Options are different because they give the buyer the right, but not the obligation, to buy or sell an asset before a certain date. An exchange-traded fund ETF is a basket of investments that trades like a stock. Instead of buying one company, investors gain exposure to many companies with a single investment. A mutual fund also pools money from many investors, but is usually bought and sold at its end-of-day value rather than throughout the trading day. Diversification means spreading investments across different assets to reduce risk instead of relying on a single investment. Market capitalization, or market cap, is the total value of a company based on its share price and outstanding shares. Companies are generally classified as large cap, mid cap, or small cap. Leverage means investing with borrowed money. While it can increase profits, it can also increase losses. A balance sheet is one of a company's most important financial statements. It shows its assets, liabilities, and shareholders' equity. Liabilities are the debts and obligations a company must repay. Inflation is the gradual rise in prices over time, reducing the purchasing power of money. Every trade involves two prices. The bid price is the highest amount a buyer is willing to pay. The ask price is the lowest amount a seller is willing to accept. The difference between them is called the bid-ask spread. A black swan event is a rare and unexpected event that significantly impacts financial markets. A dead cat bounce is a temporary recovery after a sharp price decline that is followed by further losses. A whale is a very large investor whose trades can influence the market. A unicorn is a privately owned startup valued at $1 billion or more. When investors say a stock is going to the moon, they expect its price to rise rapidly. If a stock is tanking, its price is falling sharply. Now that you've learned these important investing terms, let's move on to trading strategies, order types, stock analysis, and long-term investing principles. Now let's look at how investors make decisions and manage their investments. Short selling is a strategy used to profit from falling stock prices. Traders borrow shares, sell them, and hope to buy them back later at a lower price. While it can be profitable, it also carries significant risk, because losses can be unlimited if prices keep rising. A short squeeze happens when rising prices force short sellers to buy back shares, pushing the price even higher. A long squeeze is the opposite, where investors sell after prices fall, causing further declines. There are different ways to place trades. A market order buys or sells immediately at the best available price. A limit order executes only at a price you choose. A stop-loss order automatically sells a stock if it falls to a certain price, helping manage risk. Day orders expire at the end of the trading day, while good-till-canceled GTC orders remain active until executed or canceled. Some investors average down by buying more shares after a price drop, while others use dollar-cost averaging by investing a fixed amount at regular intervals regardless of market prices. Value investing focuses on buying companies that appear undervalued, while growth investing looks for businesses expected to grow faster than average. Earnings per share (EPS) measures a company's profit for each outstanding share. Profit margin shows how much of a company's revenue becomes profit after expenses. Return on investment (ROI) measures how much profit an investment generates compared to its original cost. Investors generally use two approaches to analyze stocks. Technical analysis studies price charts and market trends, while fundamental analysis examines a company's financial health, management, competitive position, and future growth potential. The efficient market hypothesis suggests that stock prices already reflect publicly available information, making it difficult to consistently outperform the market. Stock prices are driven by supply and demand. When demand is greater than supply, prices usually rise. When supply exceeds demand, prices generally fall. Every publicly traded company is identified by a unique ticker symbol. Successful investing is about more than knowing definitions. Diversification helps reduce risk by spreading investments across different assets. Higher potential returns usually come with higher risk, so understanding your own risk tolerance is essential. Avoid making emotional decisions. Fear of missing out (FOMO) often causes investors to buy at high prices, while panic selling during market declines can lead to unnecessary losses. Long-term investing requires patience, discipline, and consistency. Review your portfolio periodically to ensure it still matches your financial goals, and continue learning as markets evolve. Before investing, ask yourself, do I understand this business? How does it make money? Is it financially strong? What are the risks? Am I investing for the short term or the long term? Remember, no investment is guaranteed. The most successful investors rely on research, patience, discipline, and informed decision-making rather than luck. If you found this guide helpful, share it with someone who wants to learn investing. Keep learning, stay patient, and always make informed financial decisions. Thank you for watching, and see you in the next video.